Okay, so let's go ahead and get started. My name is Phil Parker. I'm with Everhard Advisors. This is Everhard Advisors University. So thank you all for jumping on the call. And today we're talking about financial planning. So I'm a financial planner, help people create financial plans, what's right for them, and set goals and achieve those financially. Really, what I'm going to talk about today is this is what I run through with clients. So it's going to be tackling the different parts of what a financial plan looks like, give you some groundwork to create your own, to hopefully to create a bunch of questions for you to think, are you financially healthy, and how do you get there? So we're going to go ahead and get into it. Um, here's one thing I will say, like, we read a lot of studies about this, and we obviously we talk to people about retirement a ton, and statistics will show that the vast majority of people think that they're going to retire and want retirement and think retirement's a good thing. Usually it's like 80% or more say that that's what they want. However, about 40% of people actually have a plan to get there. And so when we come on site and talk to people, we find the same thing individually, that people have these goals, but they don't have the plan to get there. So that's the hope for today, to create that, give you some questions and some ways to pursue that. So essentially, there's three ways you want to break down a financial plan. You want to take a look at risk management, which is just a fancy way to say insurance. And then you want to break down your short-term and your long-term planning. These are the three parts of your plan. So this is a nice way to break it up and take a look at three different ways. We're going to start with risk management and talk about insurance, and we'll get started there. This is a big thing where I find people are often confused about. I think there's sometimes some negative feelings towards insurance. I definitely have those as well. You're paying for something that you hope you never need, which is not a fun place to put your money. But hopefully I want to create a way for you to think about insurance that's going to encourage you to explore that. So common types of insurance, we obviously have life, health, disability, property, and liability. I'm going to talk about our philosophy on insurance, but I'm going to really hit life and liability today. I think that's where people typically find themselves uninsured, and we can wade into those waters. So our philosophy on insurance. The whole point of insurance is you're transferring risk from you, the insured, to the insurance company. So you pay premiums, that monthly or quarterly or annually premium that you pay for insurance. That's going to get you some kind of benefit, some kind of coverage across all those different kind of insurance. A lot of times people just don't really think this through, and they just don't really understand it, and they just ask an insurance agent, what do I need? Really, the first place you want to start with your philosophy insurance is your goal should be to become self-insured. So in this graph right here, while you're younger and you don't really have much of a net worth or many assets to draw on in case there's an emergency, then your need for insurance is pretty high, right? Maybe not when you're first starting out and you don't have a mortgage, or you're not married, or you don't have kids. But as you age and you have more and more people relying on you, then yeah, your goal for your need for life insurance specifically is going to go up. Maybe your need for health insurance isn't as high when you're younger and healthier. So we really want to think through what kind of insurance we actually need. And there's some variables. There's things that you control here. So you can get well, we'll talk about that in a second. But the goal here is to become self-insured. So say, okay, if something happens, am I able to pay for this out of pocket or not? And if you are, then you can save money on premiums. And so the whole idea with life insurance specifically is that as you're saving for retirement and as you age and you build up your assets, well, you could draw on those later in life instead of needing to transfer that risk to the insurance company. So starting with there, you always want to ask the question, when it comes to insurance, only insure against the financially catastrophic, right? So what would happen to me or my family if blank happened today? So I'm going to use myself as a lot of examples here. My wife, we have 3 kids, 3 little girls, and my wife stays at home with them. So I'm the sole breadwinner in our family. So if I were to die or if I were to become disabled, it would drastically affect my family if I'm unable to work. So I have life insurance. It's going to cover me if I were to pass away. But we also have life insurance on my wife, right? Because right now we don't pay for childcare, but if my wife were to pass away, all of a sudden we'd have huge needs there to take care of the kids. And so that would be financially catastrophic. A way to think about that too would be, if my car got totaled, that would most likely be financially catastrophic. Some people, it's not, right? They might have enough cash where they can go out and buy another car, or maybe they don't desire a really expensive car. Well, and then in that case, you don't need as much insurance, as much coverage on that. You also, the big variable that you have is keeping premiums as low as you can while maintaining adequate coverage. So you can, what you can do is keep your premiums low by raising your deductible. The deductible is how much money are you going to have to put forward towards this claim before the insurance kicks in. And so often we'll find clients that have a lot of cash and they have really low deductibles, which really doesn't make any sense. They want to be self-insured, right? You only want to, if you've got a $5 million net worth, well, then you don't need to necessarily have a really low deductible for your car, right? You don't want, you'd rather just pay low premiums. But if you don't have a lot of cash, then you're going to need lower deductibles. So think through insurance. Don't just take what's readily available, but am I getting the most bang for my buck, right? And then we want to keep investment savings and insurance savings separate. So oftentimes the insurance company is going to bundle your benefit specifically with health insurance, and they're going to have a savings component that's going to go along with it together. So just ask yourself, is this more than just life insurance? And the reason why is we typically find historically that that savings component isn't doesn't compete well with the market, right? You typically are going to earn more in the market than you would on this savings component. And it can also be expensive. So and I'll show you that in a second. Your expenses will go up, be more expensive for that insurance, and you'll underperform. So let's get into life insurance specifically. So there's going to be two big categories of life insurance. There's term and there's permanent. The big difference between term and permanent is exactly what you think. It's just the time of your insurance. So there's a term, 5, 10, 15, up to 30 years with term insurance. Your insurance is going to run out at some point. Permanent would be for the rest of your life. The other big difference between term and permanent is going to be that savings component. So a term is pretty simple. You're just going to have your term life. You're going to set your terms to say, okay, I want insurance for 30 years, and then it runs out. If I die before the 30 years, I get my death benefit. If I die after the 30 years, I don't get my death benefit. Permanent, it's a lot more complex. So there's a bunch of different kinds. Whole moving over to variable universal life gets more complex as you move from left to right. Really what changes in this is the underlying investments, but this is going to be insurance, typically to like 100 years old, maybe 105, with a savings component on top of it. To break down the coverage, so in this case, you've got term on the left, permanent on the right. In both cases, this is $500,000, so $500,000 for someone at age 43. They're a preferred non-smoker, so they're in good shape. But you can see that there's a big difference in the cost. Now, with term, you've got to choose your term. That's why we have 4 different options on the term insurance. The permanent is just one. But let's go apples to apples. Let's go as long as we can. Let's go 30 years for a male and a female. Oh, the other thing is you're going to see a difference between male and female. So men are more expensive to insure. We die more often younger. I guess we're not as smart as females, but so we're more difficult to insure and more expensive. So you can see right there on the big difference between male and female. But if we compare term and permanent, let's go 30 years even. So this would insure the term person through age 73. It's $1,000 a year for the male, $3,700 a year for the permanent insurance, $764 for the female for term, $3,100 for the female. So there's a massive difference there, a huge expense where if you were to just take the term insurance, invest the difference and build up over time, you'd expect to make significantly more money. And keep your insurance separate. So that's why I would typically recommend, hey, keep your insurance and your savings separate. go with the term because you know you're saving for retirement by age 73. You're not working anyway. So what income are you replacing? So we want to make sure we're not insuring past the point at which we really need to. So the other big question we get all the time is how to calculate insurance. It's not a fun conversation to have, right? You're finding the value of a person sometimes. There's a bunch of different ways to calculate. I typically just say the needs approach is the easiest way to go. And I'll explain what that means here in a second, but that's just, what you need if someone were to pass away. There's two periods you need to think about. So again, using my family, if I were to pass away, there is a definite readjustment period. If I were to pass away, my wife needs to go to work, but she's probably not going to work the day after I die, right? We've got 3 little kids that she needs to take care of. So there's a readjustment period that they're gonna be spending more money. She's probably not working. We're gonna need a lot more money at that point. And then it rolls into the dependency period. Once she's gone back to work, they've got a rhythm going. How much monthly do they need to be able to draw out of the investments from the insurance? So typically I tell people, let's go with the needs approach, which is just 12 to 15 times your gross pay. So in this example, if somebody makes $100,000, let's say they have $1.5 million of coverage. If you invest that properly, you could draw 5% out of that for 30 years, keeping up with inflation. So that would be $75,000 year one, which you'd be able to take out of those investments, which is a 75% replacement ratio on that 100,000. So what that means in English is you were making $100,000, take you out of the equation, your family still has $75,000 a year to replace you. And that's going to make up the difference between the cost that you have. You're no longer saving for retirement, those kind of things. So that's why 12 to 15 times gross pay typically is just going to cover it for most people. So don't overthink it, and get a term policy for relatively cheap. Get about 12 to 16 times, and then you're fine. You're really nothing else you need to consider on the insurance front when it comes to life insurance for most people. Moving on to liability, this is another place where I see people are drastically underinsured. We live in a litigious society, right? People like to sue. And so this is going to protect you from that. So protect you against claims from somebody being injured or damaged by you or on your property. So if you were to hit somebody with your car and they were to get injured, or if someone were to get injured on your, at your house, so you typically have a smaller liability policy, typically around 300,000 on your home and auto, but it can easily go above that. And so that's when a liability insurance or an umbrella policy kicks in. So you want to keep it close to your net worth. So if you're under $1 million, just get $1 million of liability insurance. It goes up in increments of 1 million. So once you cross that $1 million threshold of net worth, you'd want to bump that up. And they're typically inexpensive. Just for a few $100s, you can get $1 million of coverage. And again, a lot of people go, well, my net worth isn't that high. I don't really need this. However, sometimes it's not you that matters. It's who you injure. The example we typically use is if you were to injure a surgeon and they were hurt their hands and unable to do surgery and they were making several $100,000 a year, they could sue you. And in the state of Ohio, they can garnish wages. So you want to make sure you're protected. It's so inexpensive and so easy to get that liability insurance. It's a great way to protect yourself. If you call your insurance agent and tell them you want to bolt that on your home and auto, I'm sure they would love to do that for you. So this is a place I see people are often uninsured, and it's such an easy fix. So I would highly recommend that. All right, that is enough insurance for a lifetime. So let's move on to short-term planning. This is a big one when I sit down with people and I just take a look at balance sheets and cash flow. Are you financially healthy? This is really a big place for where I'm going to figure that out pretty quick. Can you handle an emergency? Do you have a rainy day fund? Typically, we tell people that's 3 to 6 months of non-discretionary expenses. Non-discretionary just means, what do you need to spend money on, right? You got to spend money on rent or mortgage or utilities, food, your car, clothes, those kind of things. You don't have to spend, you don't have to have a gym membership. You don't have to have a Netflix subscription. So if you were to lose your job, or if you're married and both of you were to lose your job, how do you tighten your belt? If that's $5,000 a month for you, well, you need $15,000 to $30,000 in an emergency fund. For some of you, You'd say that's cute. I can't sleep unless I have $50,000 in my savings account, right? Well, then that's a pretty good emergency fund for you there if you need that to sleep at night. But one question is, you can tip the scales too far, and you can have too much cash in an emergency fund, and then it becomes inefficient at that point. So if you're sitting there, and I'm going to throw some numbers out that some of you might think is ridiculous, but there are some people out there that have 100, 200, $300,000 sitting in a savings account. My question to you is, think of a $300,000 emergency. Can you think of one? And if the answer is no, then you probably don't need that much cash in a savings account, right? So there's a balance to this where you want to make sure you're able to pay for your own. Again, it's just an insurance policy in the short term, so you don't have to borrow to cover an emergency. But also remember, don't go too far the other direction. And I have yet to come up with a $300,000 emergency. Maybe a hostage situation where you're having to pay a ransom. Maybe that, I don't know. But if that's a possibility, I think they sell insurance for that. So I can add that to the last part. Anyway, this acts as a personal insurance policy. You want to make sure you're not going into debt to cover an emergency fund. Another great tool in the tool belt is a home equity line of credit. So if you own a home and you have equity in that house, you can set up a HELOC, a home equity line of credit. All that does is just allow you to borrow against the equity in your home. Now, I would still say this does not replace an emergency fund, that cash that we were talking about, but it does allow you to get to money quickly at much better rates than a credit card. So I would highly recommend that you can keep this on your home. It's like 75 bucks a year, probably 100 bucks a year, just to have a pretty big line of credit. So if you've got a lot of equity in your home, that's a really great way to protect yourself, just to have a HELOC sit there. All right, when we look at debt, big question right now with raising home prices, how much house can you afford? Well, if you're just looking at your mortgage debt, so what does it look like to pay for your house a month? We want to keep that below 28% of your gross pay. Typically, we find that's a pretty good threshold to stay below. However, if you do have other debts, so car notes and student loans and everything, we'd want to keep all that with mortgage below 36% of your gross pay. If you are getting above those thresholds with your mortgage debt and other debt, you could really put yourself in a tough position, because really what you're doing with that consumer debt is you're just really preventing yourself from long-term savings and net worth building. And with the short term and the long term, that's the big push and pull, right? Because I sit down with people all the time. Maybe they've got student loans, but they want to save for a house, but they also know they need to be saving for retirement. So we're ranking these goals, but we want to make sure we're not neglecting to save for the long term, because we're so focused on the short term. Because at some point it might be too late or way more difficult to save for that retirement. So we want to make sure we're balancing everything, and we want to avoid just consumer debt. I'm all right with mortgages, but we want to make sure we're not borrowing too much money to live today, because it's going to eat into your net worth building for the longer term. All right, so let's get into long-term planning. I'm going to hit on retirement pretty quickly, because this is what we talk about all the time, but I do want to hit on a couple of the things that we want to focus on with retirement. You've heard say this a million times, but control the controllables, right? If you're not currently saving for retirement, you got to start today. Typically ask people, when's the best time to plant a tree? The answer is 30 years ago, right? You get to enjoy the tree. Second best time to plant a tree is today. So best time to start saving for retirement was 30 years ago, right? If you haven't started saving, start today. There's a lot of inertia that keep people from saving. I get it. It's tough. It's delayed gratification, long-term view. Just start saving, start moving towards retirement. A future you will be very happy that you did. You want to focus on the contribution rate. You want to get into the 10 to 15% range. That's what's required for long-term savings. Obviously, you want to make sure you're taking advantage of an employer match first and foremost, but 10 to 15, that's the sweet spot that's going to put you in a good position to save. And then stay the course. Talking about investments, and if you've paid attention to the market at all recently, got people nervous. So let's talk about it for a second, because really how we want to build wealth in the long run is we want to try to double our money as often as we can. You can double your money as often as you can by getting higher rates of return. So we take a look at the US stock market. Historically, the S&P 500 index has returned about 10%. Okay, that's a 100-year average. This is actually ending in 2022. So if you had 2023 and 2024, it's a little bit higher. But the market has averaged 10%, which doubles your money about every 7 years. That's huge, right? We get to double and double and double. That last double as you approach retirement, that's where you build a significant amount of your wealth. So when we're investing, we want to own companies. We want to own as much stock as we possibly can because we want to take advantage of those high rates of return. Bonds historically have been 6, cash, let's call it 3%. And so 10 is bigger than 6 and 3. And so we want to make sure we're owning stocks as much as we can. Here's how we get 10% in stocks, okay? Doesn't feel this way, but this is the facts, right? We've got more positive years than we have negative years. So the blue in this chart are positive years, the orange are negative, and we've got positive years about 3 to 1. So 75% of the time, almost, are the stock market's positive. Also, our positive years are more positive than our negative years are negative. So because of those two things combined, more positive years than negative, and our positive years are stronger than the negative years, that's how we end with a 10% rate of return on average. But the key is you'll never get 10%, right? We're all over the place in the market. So it's long term. It's holding on, looking back on, oh, okay, over this time period, I got 10%. Because you could put money in the market today and then a year from now be down. You know, we've seen 37%. You might say Phil is not very good at his job. He doesn't know what he's talking about. But it's long term. Hold, and you would expect to make 10% in the long term. So we want to own as much stock as we possibly can. And even in times in which the market has been down, what we look at is, okay, is it going to come back, right? And so what we will look is from 1957 on, we look at all these big drops and we study how long does it take to go what's called peak to trough, top of the market to the bottom. How long does it take to recover? On average, it takes about 2 years. So all my 63-year-olds out there who are really panicking right now because the market has been volatile, while there are some other periods in which it's been longer and sustained long period of time, but we've batted 1,000 in the market recovering. It's come back every single time. So as you're approaching retirement, you just want to make sure you've got your investments in a place where some are aggressive, some are conservative, and you just draw from your conservative investments. We don't sell the stocks when they're down. If you're approaching retirement and this all sounds like gibberish, it's where we can step in and help. But just know that we want to remember and think long term with our investments. We don't want to panic in the short term. More money is lost. Preparing for the downturn than the actual downturn itself, right? That's what Peter Lynch said. So we want to make sure we understand that stocks do go down in the temporary, but they've recovered 100% of the time. So when you approach retirement, there's a huge amount of decisions you need to make. This actually should extend out to age 75. So at age 55, if you're retired, you're able to draw money out of your 401k without the 10% penalty. At age 59 and a half, you can actually draw from any retirement assets penalty free. Between age 62 and age 70, that's when you're eligible for Social Security. I'm going to talk about that in a second. Age 65 is when you're eligible for Medicare. And then age 73, if you were born before 1960, that's when your RMDs kick in, your required minimum distribution. If you're born after 1960, then actually jumps to age 75. That's when the government makes you take money out of your retirement accounts for the sole purpose that they can tax you on it. So you want to be, people call me up at age 65 and say, hey, Phil, I want to retire today. Great. But there is a huge amount of decisions that need to be made over a 20-year time period. So let's have a conversation before you get into your 60s, because some of these are irreversible, right? So we want to make some quality, wise choices. One of those big decisions, Social Security. So depending on when you were born, your full retirement age is going to be age 66 or age 67. once you start taking Social Security, you're gonna lock that in for life. And it's gonna drastically change your benefit. And the lesser you make, the bigger amount that Social Security is gonna replace in your income in retirement. So we really want to be wise in the way that we're making decisions about our Social Security, because for a lot of people, this is a huge part of their retirement picture. So again, as we approach retirement, we want to have thought out decisions on what we're doing for retirement. All right, I'm going to shift into college planning. I'm going to hit on this real quick before we get to estate planning, and then I'll take some questions. So there's a lot of different ways to fund college education. The one I'm going to focus on mainly today is the 529 college savings plans. Why the 529 plans? Mainly because of the tax advantages. So for a 529 plan, your accounts will grow tax-free if you use the earnings for qualified educational expenses. Depending on the state you're in, that can include K through 12. That is the case for Ohio. And then in some states, you can actually get a state tax deduction on your contribution rate. Again, for the state of Ohio, that's where I'm at. That's why I've got this here. That's $4,000 per year per beneficiary. So great tax advantages for the 529 plan. And you can give up to $18,000 a year, or you could lump sum $90,000 or $180,000 in for a married couple and spread that tax liability over 5 years. The other reason I like 529 plans are control. So there's a lot of misconceptions about them. So I have these for my girls, and so it's great because each one of my girls is a beneficiary. I'm the owner. I actually own the account. And their names are attached to them, but if they don't go to college, it doesn't necessarily mean they get the money. If my oldest doesn't go to college, I can change the beneficiary and make it one of my other girls. If I get all my girls through college, and we've got money left over, well, I can make myself the beneficiary and let that thing grow for a long time and use it for future grandkids. So it's a lot of flexibility in the ownership and who the account's for. Also, if one of my kids gets scholarships, I can take the money out up to the scholarship amount. I don't get penalized for that. Grandparents and friends and people can actually contribute to the 529. So you can set it up, and at Christmas, if that's something that someone wants to do, there's a code, and they can give a contribution to the 529. So there's a lot of opportunity. The other flexibility in this now is if there's money left over, if the account's been open long enough, you can actually convert some of the balance up to 35,000 to the beneficiary for Roth IRA. So a lot of flexibility. The investments are typically like your 401k. There's usually like a fixed menu. You can choose like an age-based investment option that's going to operate like the target date fund in your 401k. If you want to completely save for your child's education, how much should you be saving? Well, at birth, about $3,000, $6,000, or $9,000 per year per beneficiary if you're targeting in-state, mid-private, or elite private. So it's expensive, and it's getting more expensive to save or to completely cash flow education for your kids. Anecdotally, what I find is people really want to pay for the child's education, and that's great. Most people are unable to at this point. It is so expensive. And so I would highly recommend you, instead of, just telling your kid we're going to pay for it without a really big plan, start planning when they're younger. And it's okay for your kid to have some debt coming out of college. If they, and if they're going to a mid-private and they can't afford it, they can't afford it. That's okay. There's a lot of, I just encourage people to have real conversations with their children and themselves when it comes around education, because I see people making some decisions that drastically and negatively affect them, really. And it's a lot of promises, or they pay for that first kid and it's like, oh, no, I've got two more. How the heck are we going to do this? So just be real with yourself. I always want you to prioritize retirement. So imagine you're on an airplane and those oxygen masks come down. Whose oxygen mask do you put on first? Yourself, right? Same with education. If you have your emergency fund covered, if you've got insurance covered, if you've got retirement, if you've got everything covered, you're out of debt, the last thing I want you to tackle is education for your kid. I mean, you can borrow, there's a lot of ways to pay for it. but your kid is they under no obligation to take care of you in retirement, even if you paid for their education. So please prioritize yourself. I've come across so many people putting in 3-4% into their 401k, but also saving into a 529. I get it. You want to take care of your kids for education. I do too, but please don't do it to the detriment of your retirement. The last section I'm going to cover before we get to questions is estate planning. You want to make sure you have your basic documents. This is huge. I talk to people all day, and when we have access to 70,000 or more participants in our 401ks, and so we come across this a lot. When someone passes away, it's a terrible situation. When you don't have your estate planning done, it becomes this horrific situation where your family who's mourning the loss of a loved one is running around trying to figure out all this stuff. It creates a lot of work. It's time consuming. It costs money, and it goes through probate. If you have your beneficiary set and basic estate planning documents done, you make a terrible situation more palatable. I mean, that's it. It doesn't make it better, but I have to just emphasize to everybody out there how bad it is when someone passes away without this stuff. It really is brutal on the people left behind. So I know that if you're young, you think you're invincible, and I've come across parents whose child has passed away, and they take these accounts and they don't want them. So please, if you're over 18, you gotta make sure you got your estate work done. It's pretty simple. Your basic docs are will. So this is your last will and testament. What's going to happen to your stuff? It's the catch-all. This will go to probate. Make sure your wishes are carried out. A durable power of attorney gives somebody the ability to act on your behalf financially if you are unable to. The healthcare proxy is kind of the same concept, but for your healthcare needs. So these are your basic docs that I would recommend that everybody gets. You know, a lot of that stuff you can get online, or you can have attorneys. We can make a recommendation to who you should reach out to. We highly recommend you get these things taken care of. These are really what you need. I get asked all the time about trusts. Because of the really high estate tax exemption, about 13 million for a person, or 26 million for a couple. You know, the need for trust when it comes to taxes to avoid estate taxes, it's not, for the vast majority of people, you don't need it. They are really good for control. So again, I've got 3 little girls who I love. They're not great with money. They always spend it on graders like immediately as soon as they get it. So, and maybe at the age of 18, they might not be that much better. And so if my wife and I were to pass away, we want to make sure that the money my girls are taken care of, and taken care of for a long time. So we've got money flowing into a trust that's going to make sure that they have money for the long haul and keep some control over it. So that's really my quick thing on trust. I can answer more questions about that later, but you want to make sure you review at the 5 Ds all your estate planning. So that's if you have a new dependent, you get a divorce, there's a death, there's a disability, or there's a new decade. You want to make sure you're revising these things. Example I always give, my parents, we reviewed their estate work, and in their estate work, my grandma had custody over me. But at that time, I had kids, and my grandma had passed away for years, and so they hadn't reviewed it. Last thing with estate planning, please make sure you have beneficiary designations on all your accounts. This supersedes wills. So it's a really fast way to make sure you get money to your beneficiaries. It goes quickly and easily. And so make sure you got beneficiaries on all your accounts, whether it's bank accounts or investment accounts. Review that, make sure your beneficiaries are set up. And then the financial resources. So if all the calculators and stuff to take a look at college, retirement, mortgage, anything you need, bankrate.com is a great place for that. I highly recommend that everyone goes on Social Security, the website, ssa.gov, and set up your account. It's a really great way to know what your Social Security benefit would be at retirement or at any point. And the nerdiest thing I'm going to say today is it's pretty cool. You can go back and look at all of your earnings that you've made through your working career. So everyone go to ssa.gov and set up your account now. And you can always reach out to us, 844-GOT-401k, or email us at help@everhardadvisors.com. If you'd like to set up a one-on-one consultation, we can run retirement projections, talk insurance, Social Security, any of this stuff for you. The point of today was to give you all the information to say you should be thinking about all these things, but there are various levels of complexity, and that's what we are here for. Please utilize Everhard Advisors. We'd love to sit down with y'all and take a look at your individual situation. Our next EAU next month, we're going to talk about investing in stocks. About as basic as you can get. I meet with hundreds of people, thousands of people possibly a year, and I often had this exact conversation where we're talking investments, retirement, and I say, do you know what a stock or a bond is? And the majority of people say no. So just so you know, nobody knows this stuff. And so our job is to educate and make sure you understand it. So there is no shame in understanding the basics and logging on. But this is our whole calendar. We're going to get into more annuities in June, estate planning. We're going to have an attorney on in July. Social Security and Medicare are always big ones in the fall. So that's everything I've got for you today. Any questions? I believe there is a Q&A box. That's what it's called. If you have any questions, you can throw it in the Q&A box. I will start to get through there. Somebody asked, are there special requirements to draw from a 401k after 55 and before 59 and a half? Yes, and so you have to be terminated from that company. You can, if you're currently working for that 401k and you draw money out of that 401k, even if you're able to through like an in-service distribution, you'll get hit with a 10% penalty. But if you're no longer working for that company, if you're retired from that company and you're 55 and above, you can be able to draw money out of it. Quick caveat on that though. Some 401ks do not allow for partial distributions. So that is a big thing to make sure you want to plan around that. If you are in a 401k that doesn't allow for partial distributions and you retire at age 55 and you go to take money out, you might be in for a world of hurt. You might have to take it all out, which could be a huge tax bill, or take a little bit out and roll over the rest. So make sure you know that if you're trying to take money out of your 401k prior to 59 and a half. Are 529 contributions always post-tax? And if so, are there any tax advantages of contributing each year? How does that work at tax filing time? So yes, your 529 contributions are always post-tax. It's not like a 401k contribution. So you're going to contribute to your 529 with after-tax dollars. But if you live in a state where it's deductible, you would receive a tax form saying that you put money into the 529. And when you file your state taxes, you would then be able to deduct, like in the state of Ohio, it's up to $4,000 you can deduct. In Indiana, it's actually you get a claim, it's up to like $1,000. Yeah, I forget exactly how it works, but it's pretty substantial. But it's different per state. If you don't have state income tax, then you wouldn't be able to deduct it. So you'll get a form from from your 529 that'll say that you contributed to that year, and you'll be able to deduct that off your state taxes. So yeah, if you're looking to do a 529C, if you're in Ohio, it's a deduction. Indiana's, it's a credit. Some states allow it, some states don't. But that's the tax advantages are the fact that the account grows tax-free. So all the gains in the account are not taxed when you pull money out for qualified expenses. And then some states allow for a state tax deduction. Any other questions out there? If you're unable to find the chat box, I think there might be a raise your hand ability and you might be able to like ask a question. But feel free to type in any other questions. I know we covered a lot. Somebody asked, yeah, the state tax deduction for the Ohio 529 is $4,000 per year per beneficiary. So that would be per kid, but it's actually per beneficiary. So it's not just limited to your kids. It's any account that you contribute to. Any other questions out there? All right. Well, thank you so much for jumping on the call, everybody. Again, if that QR code that's on the screen there, that's going to take you to EAU, but please reach out to us at help@everhardadvisors.com. Email us. We can set up a consultation to help you figure out, what a retirement plan and financial plan looks like for you. But thank you so much and have a wonderful day.